What if I told you that America's newest housing solution could turn your mortgage into a lifelong prison sentence? What if the very policy designed to help you buy a home could actually guarantee you'll never truly own it? My name is Nick, and I've spent years helping people understand how money really works. Today we need to talk about something that could fundamentally change homeownership in America forever. We're talking about 50-year mortgages, and if you think this sounds like a reasonable solution to our housing crisis, you're about to discover why this might be the worst financial trap ever created. Now, before we dive into the nightmare mathematics of this proposal, let me ask you something. When you picture retirement, what do you see? Maybe you're imagining yourself finally free from work, enjoying your golden years without the stress of monthly bills. For generations, that dream included one crucial element, a paid-off house. But what we're about to discuss could eliminate that possibility entirely. Here's what's happening right now. The average first-time homebuyer in America is now 40 years old. Let that sink in for a moment. 40 years old. That means people are working for 2 full decades before they can even think about buying their first home. And now, politicians are proposing a solution that would have these 40-year-old first-time buyers making mortgage payments until they're 90. Yes, you heard that correctly. 90 years old. The pitch sounds almost reasonable at first. Lower monthly payments, they say. More affordable homeownership, they promise. Finally, a way for ordinary Americans to achieve the American dream without breaking the bank every month. It's the kind of proposal that sounds great in a 30-second political ad. But like most things that sound too good to be true, it absolutely is. Let me walk you through the real mathematics of what we're talking about here because the numbers are genuinely shocking. Take a $400,000 home, which is roughly the median price in many American markets today. With a 6% interest rate, here's what your financial future looks like. With a traditional 30-year mortgage, you'll pay roughly $863,000 over the life of the loan. That means you're paying $463,000 in interest alone. Now, that might already sound like highway robbery, and honestly, it kind of is. But wait, because it gets so much worse. With a 50-year mortgage on that same $400,000 house, you'll pay approximately $1.26 million total. That's $863,000 in interest. You're literally paying almost double the interest for the privilege of spreading your payments out longer. The monthly savings? About $290. You're paying an extra $400,000 over your lifetime to save less than $300 per month. That's like buying a cup of coffee every day and having it cost you your children's inheritance. But here's where this gets even more disturbing. Warren Buffett has spent decades teaching people about compound interest, calling it either your best friend or your worst enemy. In the case of a 50-year mortgage, it becomes your absolute worst nightmare. Every single extra year you stretch that loan, interest compounds against you with mathematical precision that would make a casino jealous. Think about it this way. Compound interest is supposed to work for you when you're investing. You put money into the stock market, and over time, your returns generate their own returns, creating this beautiful snowball effect that builds wealth. But with a 50-year mortgage, you flip the script entirely. Now, compound interest is working against you with the same relentless efficiency, except instead of building wealth, it's systematically destroying it. This brings us to a story that should terrify every American, and it's a story about Japan in the 1990s. Japan faced a similar housing affordability crisis. Property prices had gone absolutely insane, and regular families couldn't afford to buy homes. Sound familiar? Instead of addressing the underlying supply issues, the Japanese government introduced 50-year mortgages as a quick fix. You know what happened next? Their real estate bubble didn't just pop, it exploded. The market collapsed by 70%, and it took 36 years to recover. 36 years. Think about that timeline. If you were 25 years old when it crashed, you were 61 before the market got back to where it started. An entire generation lost their prime wealth-building years to a policy that was supposed to help them. Japan's lost decades weren't caused by 50-year mortgages alone, but these extended loans certainly didn't help. When you make it easier for people to borrow more money, you don't actually solve affordability. You just hide the problem while making it exponentially worse. Here's the psychological trap that makes this whole scheme so insidious. Your brain absolutely hates big numbers, but it loves small numbers. Behavioral economists call this payment bias. We naturally focus on monthly payments instead of total cost, and this cognitive quirk has made entire industries incredibly wealthy at our expense. Car dealers figured this out decades ago. They don't ask if you can afford a $40,000 car. They ask if you can afford $650 per month. Suddenly, that massive purchase feels manageable because you're only thinking about the monthly payment, not the crushing total debt you're taking on. The 50-year mortgage exploits this exact weakness in human psychology. You see that $290 monthly savings and your brain immediately thinks, I can afford this now. But your brain conveniently ignores the $400,000 in extra interest you'll pay over your lifetime. This is the financial equivalent of being offered a payday loan by someone in an expensive suit. The monthly payment looks reasonable, but the total cost will bankrupt your future. What's really happening here is that you're trading short-term relief for long-term poverty. You're solving today's problem by creating a much bigger problem for future you. And future you is going to be really, really angry about this decision. The underlying crisis driving this proposal is real, and it's getting worse every year. The median home price has exploded far beyond what most families can reasonably afford. Mortgage rates are stuck between 6 and 7%, which is dramatically higher than the near zero rates we got used to over the past decade. Meanwhile, wages have barely kept pace with inflation, let alone housing costs. So what's the real solution to this crisis? It's actually remarkably simple, even if it's politically difficult to implement. We need to build more houses. That's it. That's the answer. More supply brings down prices. This is economics 101, and it works every single time it's tried. But building more homes is hard work. It requires changing zoning laws that have been in place for decades. It means convincing suburban homeowners that their neighborhoods can handle a little more density. It takes time, political will, and the courage to upset people who benefit from the current broken system. 50-year mortgages, on the other hand, are easy. They require no structural changes to how we build or zone housing. They don't upset existing homeowners. They just let people borrow more money for longer periods, which creates the illusion of solving the problem without actually solving anything. Instead of fixing the problem, politicians are doubling down on making it worse. Or they're basically saying, hey, you can't afford a house, no problem. We'll just let you make payments for the rest of your natural life. This is like treating a broken leg by giving you crutches that are designed to break in 20 years. You feel better temporarily, but you're setting yourself up for a much worse fall later. But wait, there's more. And by more, I mean the situation gets exponentially worse when you consider what happens to your equity building. Remember, equity is supposed to be the whole point of homeownership. It's the difference between your home's value and what you owe on the mortgage. It's your ticket to building generational wealth. With a traditional 30-year mortgage, you start building meaningful equity after about 7 to 10 years. After 15 years, you own a substantial chunk of your home. After 20 years, you're in the home stretch to complete ownership. It's a predictable path that has created middle-class wealth for generations. But with a 50-year mortgage, you're basically paying rent to the bank with a fancy piece of paper that says you own the place. After 10 years on a 30-year mortgage, you've paid off about 16% of your loan. After 10 years on a 50-year mortgage, you've paid off less than 4%. 4%. Let me put this in perspective. After a full decade of making payments on a 50-year mortgage, you could sell your house and you'd still owe almost exactly what you originally borrowed. Every payment you made went almost entirely to interest. The bank gets rich, you get nothing. This means you're underwater for longer, you can't refinance when rates drop, and you can't sell without taking a massive loss. You're not a homeowner, you're a long-term renter who also happens to be responsible for maintenance, property taxes, and insurance. Now let's talk about what this does to retirement planning, because this is where the 50-year mortgage goes from being a bad deal to being a complete disaster. For decades, the standard American retirement strategy went something like this. Work for 30 to 40 years, pay off your mortgage by age 65, then retire with Social Security plus whatever you manage to save. The lack of a housing payment in retirement was crucial to making the numbers work. Social Security was never designed to cover both your living expenses and a mortgage payment. The average Social Security benefit is about $2,000 per month. The average mortgage payment on a 50-year loan for a $400,000 house is about $2,000 per month. Do the math. Social Security doesn't even cover your housing payment, let alone food, healthcare, and everything else you need to survive. So what happens when you reach traditional retirement age but still have 25 years left on your mortgage? You have exactly 3 options, and they're all terrible. Option 1, keep working until you're 80 or 90 years old. Option 2, sell the house and downsize to something you can afford, except you haven't built enough equity to make this work. Option 3, become a financial burden on your children. Speaking of your children, let's discuss the generational wealth destruction that 50-year mortgages create. Homeownership has traditionally been how middle-class families pass wealth to the next generation. Parents buy a house, pay it off over 30 years, and when they die, their kids inherit a valuable asset, free and clear. That inheritance helps the next generation buy their own homes or provides financial security during tough times. But with 50-year mortgages, you're not passing wealth to your children. You're passing debt. When you die 20 or 30 years into your 50-year mortgage, your kids inherit a house that still has 20 to 30 years of payments left. They can either take over the payments, sell the house, and use whatever tiny equity exists to pay off the remaining debt, or walk away and let the bank foreclose. None of these options create generational wealth. They create generational poverty. The really insidious part about all of this is how the 50-year mortgage interacts with housing prices themselves. When you make it easier for people to borrow more money, you don't actually improve affordability. You just drive prices higher. Think about it logically. If everyone in the market suddenly has access to 50-year mortgages and can therefore afford to pay an extra $200 to $300 per month, what do you think happens to home prices? They go up by exactly the amount that the monthly payment decreased. It's like giving everyone in an auction more money and expecting the winning bids to stay the same. This is what economists call induced demand. When you make something easier to buy, more people try to buy it, which drives up the price until it's just as hard to buy as it was before. The only difference is now everyone is paying more and taking on more debt. So the 50-year mortgage doesn't solve the affordability crisis at all. It just moves the problem around and makes it worse. Houses cost the same monthly payment as before, but now you're paying that monthly payment for 20 years longer. The mortgage industry absolutely loves this, by the way. They make their money from interest payments, and a 50-year mortgage generates almost double the interest of a 30-year mortgage, right? From their perspective, this is the greatest policy proposal ever created. They get to collect interest payments from you for 2 decades longer while taking exactly the same risk. Banks aren't stupid. They understand compound interest better than almost anyone. They know that extending mortgages to 50 years is incredibly profitable for them and incredibly expensive for you. The fact that they're enthusiastically supporting this policy should tell you everything you need to know about who benefits and who gets screwed. And here's something that should make you even more suspicious. The same politicians proposing 50-year mortgages are often the ones who have spent decades talking about the importance of homeownership and the American dream. If they really cared about making homeownership accessible, They'd be focused on increasing housing supply, which would bring prices down for everyone. But building more housing is politically complicated. It requires convincing existing homeowners to allow more density in their neighborhoods. It means updating zoning laws that have been in place for 50 years. It takes time, effort, and political courage. 50-year mortgages, on the other hand, are politically easy. They don't upset anyone who matters. Current homeowners love them because they keep demand high, which supports property values. Banks love them because they generate more profit. Politicians love them because they can claim they're helping first-time homebuyers without actually doing any of the hard work required to fix the underlying problem. The only people who get hurt are the borrowers themselves, and by the time they figure out how badly they've been screwed, the politicians who sold them this bill of goods are long gone. What makes this proposal especially dangerous is how it preys on people who are already struggling. The average American already carries over $9,000 in credit card debt at 20% interest. They're already making minimum payments on student loans they'll never fully repay. Now, we want to add a mortgage payment that lasts until they're eligible for Medicare. This isn't financial planning. This is financial desperation disguised as policy innovation. Let's talk about what happens when life inevitably gets in the way of your 50-year payment plan. Because life has this funny habit of not following your perfectly calculated budget spreadsheet. What happens when you lose your job in year 15 of your mortgage? With a traditional 30-year loan, you might have built enough equity to sell and downsize. With a 50-year mortgage, you're probably still underwater. You can't sell without writing a check to the bank just for the privilege of walking away. What happens when you get divorced? Splitting assets becomes a nightmare when the primary asset is actually a liability. Neither party can afford to keep the house, but neither can afford to sell it either. Congratulations, your mortgage has now become a financial anchor, dragging both of you to the bottom of the ocean. What happens when your parents get sick and need care? Traditionally, families could tap into home equity to pay for elder care, but when you've only paid off 4% of your mortgage after a decade, there's no equity to tap. Your parents' care becomes another debt burden on top of your existing debt mountain. And here's the really twisted part. The politicians pushing this policy know all of this. They understand compound interest. They understand that extending mortgage terms makes banks richer and borrowers poor. But they also understand that most voters don't think about total cost over 50 years. They think about monthly payments over the next few months. It's the same reason lottery tickets are so popular. People focus on the tiny chance of winning millions instead of the mathematical certainty of losing their money. Humans are remarkably bad at evaluating long-term financial consequences, and the 50-year mortgage exploits this weakness with surgical precision. The marketing for these mortgages will be absolutely brilliant, by the way. They'll show you commercials with happy families moving into beautiful homes. They'll feature testimonials from grateful borrowers who finally achieved homeownership thanks to lower monthly payments. They'll use phrases like affordable path to the American dream and finally a mortgage that works for working families. What they won't show you is that same family 20 years later, still making payments on a house that's falling apart, still owing almost exactly what they originally borrowed, watching their retirement dreams evaporate one monthly payment at a time. They won't interview the 70-year-old borrower who thought they'd have their house paid off by retirement, but instead faces another 20 years of payments on a Social Security income. They won't feature the adult children who inherited not generational wealth but generational debt. The most frustrating part about all of this is that we actually know how to solve the housing crisis. We've known for decades. It's not complicated, it's not mysterious, and it doesn't require financial innovation that would make Wall Street executives salivate. Build more houses. That's literally it. When you have more supply than demand, prices fall. When builders compete for buyers instead of buyers competing for houses, everyone wins. This isn't theoretical economics, it's observable reality in every market where supply restrictions have been removed. Look at Houston, Texas. They have some of the most relaxed zoning laws in America, and guess what? They also have some of the most affordable housing relative to local incomes. Builders can respond quickly to demand, supply stays ahead of population growth, and families can actually afford to buy homes without selling their souls to the bank. Compare that to San Francisco, where it takes an average of 4 years and hundreds of thousands of dollars in fees just to get permission to build a single house, where zoning laws written in the 1920s prevent apartments from being built near job centers, where existing homeowners use environmental reviews as weapons to block any new construction that might threaten their property values. Which city has the affordable housing? Houston. Which city is desperate enough to consider 50-year mortgages? San Francisco. The pattern is so obvious it's almost insulting that politicians pretend not to see it. So here's what you need to remember. The 50-year mortgage isn't solving the housing crisis. It's making it worse while pretending to help. You're not getting a better deal. You're getting a longer prison sentence with better marketing. The math doesn't lie, even when politicians do. If you can't afford a 30-year mortgage, a 50-year mortgage won't save you. It'll just make your financial problems someone else's inheritance. Don't let them turn the American dream into a generational nightmare.